My name is George Sardakis. I am an associate at First Financial Services, and I want to make sure that everyone is taking advantage of the benefits that your employers may be offering. Now, we're going to go over a couple of different popular types of employer-sponsored benefits packages and the offerings that they may be providing and what they mean for you and how we can take advantage of them. And so, for many young professionals, the benefit package that's offered by their employer is worth about 20 to 30% on top of the base salary that they're already getting. And today, I want to make sure that we're taking advantage of that extra benefit and essentially a pay raise in some regards. And so we're going to start with a 401k. A 401k or a 403b is a retirement plan that's offered by our employers. Essentially, what it is, it's an account that we defer money to on a payroll basis. So as we get paid, whether it's weekly, biweekly, monthly, there's a chunk of money that comes from our paycheck and it goes into this retirement account that's held at our employer sponsored. And so let's say we're contributing 5% of our weekly paycheck and we get paid $1,000 a week. $50 on a pre-tax basis if we're contributing to a traditional 401k, which means 5% of that $1,000 or $50 a week is going from our paycheck into our retirement account that's held with our employer sponsor. On top of that, our employer may even match up to a certain percentage. And for sake of this example, let's say another 5%. So our employer will match 5% up to 5% of our salary, which is an additional $50. So a total of $100 is going into this retirement account for our future benefit. Now, there are two ways to contribute to a 401k. You can contribute on a pre-tax traditional basis, which means that if we get paid $1,000 a week and we put $50 away into this 401k, that means that on a weekly basis, we're actually getting taxed on $950. And as those funds continue to grow, they're going to grow tax deferred. But when we take the money out of the account in retirement after age 59 and a half, the money's actually going to be taxed as income. Every dollar that has grown in that account from dollar zero is going to be taxed on an income tax basis. Whereas with Roth, which is another option that's offered through our 401k, the dollars are offered on a post-tax basis, which means that if we have $1,000 paycheck and we contribute $50, we're still getting taxed on $1,000. But what happens is those funds continue to grow and they grow tax free. So after 5 years of the assets being in that account, assuming we pull the money out after age 59 and a half, we're actually able to take all of the funds, every single dollar out tax free. It's not uncommon for employers to offer a match on our funds. So if we contribute 5%, the aforementioned 5%, and our employer says we'll match up to 6, well then if you put 5% of your paycheck in, they're not going to match 6 because you're not putting 6 in, they'll match the 5. So what we often want to take advantage of is at least what the company is going to be matching. So if the company is matching 6, we should at least take advantage of the 6% contributions. This way we can get the full 100%, basically dollar for dollar match that the employer is providing. Now, what happens within that account is that the funds are invested based on a selection of mutual funds that are preset. Think of it like a restaurant menu. You go into a restaurant and you have a set menu that you're able to choose from. So whether it's steak or salmon or chicken or pork chop, that's what the restaurant offers with regards to the entrees for that night. You can't go into that restaurant and ask for enchiladas when it's a steakhouse. They don't offer that on the menu, just like an investment portfolio in a 401k. They have a preset menu of investment options that we're able to choose from. And from there, we build our portfolio on a self-directed basis. When it comes to these investment allocations, we usually want to review it at least annually. So this way we can make sure that the account is performing well. We want to see how the account is performing. We want to see how the account is allocated and if we want to make any changes. Another significant benefit that we often don't take advantage of, especially young professionals, is health insurance elections. At age 26, we get kicked off of our parents' health insurance plans. So we want to make sure that we understand the health insurance options that our employers are providing. So there are two primary types of health insurance plans. You have a PPO, which stands for Primary Provider Organization Plan, or an HDHP, or a high deductible health plan. And the primary difference between the two is that the PPO usually offers higher premiums and therefore lower out of pocket costs. But in exchange for that, you have more flexibility in terms of the providers that you're able to see, whether it's a chiropractor or dermatologist or orthopedic. You have a broader network of doctors that you're able to see when it comes to PPOs. On the other hand, when it comes to HDHPs or high deductible plans, you have a lower premium, so it costs you less on a monthly basis, but you have a higher deductible, which means you have a higher threshold to hit before the health insurance actually pays out on a shared basis. The benefit to having an HDHP is that it qualifies you for what's called a health savings plan or an HSA, health savings account, which means that you're able to make pre-tax contributions to this HSA, which can be invested similar to a 401k. They're invested on a tax deferred basis on within a pre-selected portfolio. But when you go to take the funds out, assuming that you use it for a medical expense, you can actually pull the funds tax free for qualified medical expenses. And that's a big deal. So you have a triple tax savings here that's offered by an HSA. And so when we take a step back, if we're analyzing and we're trying to decide which health insurance plan we should select from our employer, we want to make sure that we are doing what's economically feasible for us. And so if we're young and healthy and we don't really use our insurance a lot, it may benefit us to select a high deductible plan because we're going to be paying less out of pocket premiums on a monthly basis. And if we have a catastrophe, like if we have to go to the emergency room or if we have to go do a hospital visit, we're going to hit that deductible relatively easily. Whereas if we have a couple different doctors that we go to see and we go to see like an allergist or an orthopedic on a regular basis, those copays add up relatively quickly. So it would probably benefit us to pay a bit of a higher premium and have a lower out of pocket cost and share in the health expense with the insurance provider in that regard. So that's where a PPO would probably be beneficial. A benefit that usually goes underutilized with young professionals, in addition to the health insurance, is the life and disability insurance offering. Life insurance, as we covered in a previous video, offers a death benefit to our beneficiary. So if God forbid something happens to us while we're employed with the company, and that's different from an individual policy. If we're hired by company ABC and they offer a one-time salary or three-time salary life insurance plan, if we make $100,000, they'll offer a $300,000 death benefit life insurance plan as long as we're employed by company ABC. When we go to leave company ABC, that life insurance policy goes away. Now, this could also be a big deal for those of us who maybe it's a little more difficult or a little more costly to get life insurance. Having a group benefits plan in place, if we're with a company that we intend on being with for a good number of years, could be extremely beneficial and cost effective if we supplement that also with an individual life insurance policy. How we could supplement that with an individual life insurance policy is when we take a step back, we want to make sure that we're maintaining at least 10 to 12 times annual income in total life insurance coverage. So if the group benefit already offers us three times, let's say, salary, we could pick up another smaller life insurance policy that can help cover the gap, or at least supplement up to 10 times or 12 times salary, or somewhere within that range. The reason why group life insurance policies are typically more cost effective than individuals is because the group policy is underwritten at a group rate. So it takes the average health of the employees and the average age and all that fun stuff, and it applies it to the premium rate that the group is going to be paying. So if we have a couple of health issues and it's a bit more costly to get on an individual life insurance policy where the individual is underwritten, it may be beneficial for us to get on a group plan where we may be paying less because we're looked at as an aggregate group, and that's the premium that we're going to be paying. On the other hand, if we're younger and we're healthier, it may be cheaper and more cost effective for us to get an individual policy because we're going to be underwritten with our peers on the group basis, and it may be a couple extra dollars a month, which we could use to do other things with. And so that's a bit of the balance that we have to strike when it comes to looking at group policies. On the disability front, there's two different types of disability insurance that the employer may offer. You have short-term disability, which typically replaces 60 to 70% of our annual income. And that's if we are disabled or considered or deemed disabled for about 3 to 6 months. So if we go on maternity leave, or if we have to go get surgery because we messed up our shoulder, or whatever the disability may be for that short term, we're going to be able to get up to 60 to 70% of our income based on the employer's coverage that's offered. With regards to long-term disability, this typically kicks in after the short-term disability expires. There's a bit more of a process when it comes to that to see if you're truly disabled and you're unable to operate or work in the same capacity that you were working before. And this typically lasts through retirement. Long-term disability is usually more common when it comes to individual disability policies, which we could do another episode on later on. And leave a comment below if you'd like to understand a bit more disability insurance, which is usually considered to be own occupation, which means that we're not able to function within the capacity of our own occupation for the duration of our career. So these different policies should be considered and reviewed annually just because the benefits may change or our salaries may increase. We want to understand what we're covered for with regards to life insurance if something happens, or disability insurance if we need to have our income replaced. The final type of benefit that isn't usually offered a lot, but when it is, it's very important to understand, is equity-based compensation. It's becoming increasingly common in technology companies, finance firms, or companies that are just in hyper growth stage. And so there's three main types of equity-based compensation that we should be aware of. The first is called RSUs, or restricted stock units, and that's essentially when, usually based on a bonus, where the shares are granted to us on what's called a vesting schedule. So if we're eligible to receive 100 shares of company ABC that we work for, that 100 shares may be scheduled over the course of the next 4 years. So we may get 20 shares now, we may get 30 shares in the second year, and then 20 shares, and then the remaining 30 shares in years 3 and 4, respectively. And so what happens there is that even though we have 100 shares that may be coming to us, we're only really receiving on the vesting schedule, which means that we're going to be taxed as such. We're going to be taxed on the market price of those shares when they vest. The second type of equity-based compensation is what's usually referred to as stock options. And that's when we receive the right to purchase a stock, the company stock, at a set price. And the set price is usually determined by the value of the stock. So if the value of the stock is $10 a share, we get the opportunity to purchase the shares at fraction of the cost, but we're also taxed differently than we would be at RSU price. And I would speak with a tax professional with regards to how we're taxed on stock options that are equity-based compensation. The third type of equity-based compensation is what's called an ESPP, or an employee stock purchase plan, whereby we have the ability to purchase the company stock at a discounted price. So if the company stock trades at $100 a share, we may get a 15% discount on those shares. And then we have the right to sell it at the market price. So if the stock trades at $100 a share and we have a 15% discount, we can purchase the stock at $85 a share. And then if the stock market price appreciates to $120, we can then sell the shares at $120, giving us a $35 profit on the sale of that particular share. And so to wrap all of this up, we want to make sure that we understand that our compensation isn't just what we're getting on a salary basis. Our compensation also includes things like our life insurance that we get through group, or our 401k contributions, our health insurance plans, equity-based compensations that may be given to us as an incentive or a bonus. All these different things help to make up our total annual salary. So we want to make sure that we're asking ourselves, are we capturing our full employer match on our 401k? Are we taking advantage of an HSA if it's offered to us through our employer? Am I investing the balance in that HSA? Does my employer offer equity-based compensation? If so, what kind of equity-based compensation are they offering? These are all different benefits that we want to make sure that we're taking full advantage of in addition to our salary. And so, with all of that being said, thank you so much for watching. Please make sure to subscribe, like this video, comment below if you'd like to see other videos on different topics, and I hope to see you all next time. Thank you so much.